Hi everyone, welcome back to Father and Son Investing. In today's video, we're going to delve into an important topic that every investor needs to be aware of, and that is the hidden impact of investment fees when it comes to your total returns. Today, I'm going to show you just how much fees can eat into your returns, and trust me, it is a lot. I'm going to give you an example, a real-world example from my Schwab account that I experienced recently, where I discovered just how much I was paying in fees after neglecting an account for a number of years. I'm going to show you the way that you can calculate the difference fees will make in your total returns. There's a very handy investment calculator for that. We're going to talk about the types of fees you might be paying. I'm going to talk about what is a reasonable fee to expect to pay for investing. Investing is not free. And then lastly, I will wrap it up by showing you an example of how you can compare one ETF another when it comes to comparing their fees. So let's get started. I like to think of fees as weeds in your garden. If you have a garden and you have given it good soil, you've given it some good fertilizer, you water it adequately, it's getting adequate sunlight, that garden can give you way more returns than a garden that's full of weeds that are crowding out the roots of those plants, or perhaps they've grown so tall that they even crowd out the sunlight trying to get to your garden. That's the way I think of fees. In fact, here's just a quick example of how investing fees can affect your total returns. This is from investright.org. There are lots of calculators out there. I'm going to show you one that I really prefer here in a little bit, but this is a quick example. A person invests $50,000 for 20 years, average annual return only 5%. That's very conservative. Fees of 1.5% versus 0.4%. And when we run those numbers, we see that the total account value in 20 years for the 0.4% fees, $122,000 versus $99,500 at 1.5%. So you're looking at about $23,000 difference. Now, I think that it's important to learn from other people's mistakes, so let me show you a mistake that I made recently when it came to fees. Back in 2018, my wife and I were considering hiring a financial advisor, and so we decided that we would run a little test. We'd go ahead and give them $25,000 to invest for us, and I would continue to invest also in my Vanguard investment account, and then we would just compare the results when we finished the test. Well, we've kind of neglected this account. I have paid attention to it from time to time when I had to pay taxes each year, but I have noticed that the account was increasing in value, and other than that, I really haven't been paying too much attention to it, particularly the fees that I was paying until recently. Recently, we had a big ticket purchase item coming up, and we wanted to go ahead and be able to cash out this account so that the cash would be available when we wanted to pay for this particular item. So here you'll see that the account starts to go flat. That's where I fired the financial advisor, not because I thought that they were doing a terrible job per se, but because I was getting ready to be able to spend this cash. Well, recently I noticed on a statement the fee that I was paying. They actually can kind of hide this fee. It's a little difficult to find sometimes, but if you're looking at your statement, just go ahead and do the Control or Command F and then search for fee, and you'll be able to find your advisor fee that you're paying if that's the case. Now, what I've done here is I've gone ahead and filtered the history of my account only by fees. Now, Charles Schwab would only let me go back to January of 2020, so I don't have those first 2 years of the fees that I've paid. But when I saw the sum here, I was actually a bit shocked, $1,321. Now, if I were to calculate in the fees for 2018 up to 2020, I'm looking probably at about a half of that sum again, so maybe another $700, so about $2,000 is what I paid my advisor, who I won't mention, but was managing this through a Schwab account, for the privilege of managing my money for those 5 years. Now that then begs the question, how much more money would I have in my account if I hadn't been paying that 1% advisor fee, because that's what I was paying? Now, it would not only be the $1,300 to potentially $2,000 that I paid them in fees, but what sort of return that $1,300 to $2,000 would have earned during that time. Now, there are a number of financial calculators out there that can help you calculate the total effect of fees on your returns and thus your wealth building. But I really like this one at Schwab. It's at schwabmoneywise.com, and I will put a link to it down below. What I've done here is put in the $25,000, 5 years. We did not add any additional money to this account. We'll assume an annual average return of 7%. I didn't go ahead and calculate the actual return during those 5 years that we had this money invested, but we'll use that average of 7%. And then what I like here about Schwab is it allows you to put in various investment fees so that you can see the difference. So 0.2% is what I would expect to pay on a reasonable low-cost ETF, an index ETF. 0.2% is certainly reasonable for that. The 1% fee is what the advisor was charging. And then what I've done is gone ahead and make this 1.5% down here. And that is to sort of also add in the extra fees that the items that they were investing me into may have been incurring me as well. So that's why I've got these three different categories here. When we go ahead and run these numbers, what we see is that at the end of 5 years, what I should have expected to have was $34,737 if I was paying just 0.2%. However, if we get to this 1.5%, then what I see is that I would have had about $32,673. Now, if you remember correctly, when I showed you the total of my account, it's about $31,000. So I actually was earning less than what I should have been earning, even at 1.5%, meaning that my advisor was earning me less than what I could have been earning on the market. Now, most of us honestly are not going to be investing this way, so let's just change the numbers into something that sounds a little bit more reasonable and lifelike. Okay, so what I've done is change the numbers here. Starting amount now is $100,000. We're going to invest for 30 years, and we're going to continue to put money into our account, which what most people are probably going to do. So I've made this kind of $250, which sounds reasonable to me. Certainly some of you may be investing far more than this. Same numbers down here, and when we run the numbers, you start to see the big difference between the blue line, which is at 0.2%, fee, and the gold line here, which is at that 1.5% fee. Look at the difference. After 31 years, you have just a little bit more than $1 million in this scenario. But if you're paying a 1.5% fee, that balance goes down to $722,000. The difference between that 0.2% fee and the 1.5% fee, $280,000. What would you do with an extra $280,000 in retirement? Now, some of you may be thinking 1.5% sounds very excessive and not very realistic. However, in this article over at Fortune.com, when we scroll down, we see here that at least according to one of the consultants that they spoke to, the average investor pays from approximately 1.5% to 2% annually. That is the average investor. That actually astounds me, 1.5% to 2% annually. Part of the way that happens is that these fees can add up. This is a nice graphic that gives you an idea of just the type of fees you may end up paying. Not only might you be paying the investment financial advisor fee, that was at 1% that I was paying my advisor, but there may be a broker fee. So in this case, Schwab may have a fee in there. You may have some trading fees or initial fees. Now, a lot of the brokerages have gotten rid of trading fees, but what they do is they make up for that in terms of the bid-ask spread that they charge when you buy or sell a stock. So those brokerages aren't working for free. They're still making money. Then you may have just some ongoing fees such as management fees. You may have some performance or success fee. If they do really well for you and earn you a lot of money, you're going to pay them a bonus. You may have some exit fees when you go to get out of your investment, or perhaps an early withdrawal or penalty fee. So lots of different types of fees can start to add up, and when you start to sum all of those together, the average investor is paying 1.5% to 2%. That is astounding. Now, there's an interesting article over at Morningstar that was produced back in 2019. If you're not aware, every year Morningstar produces a paper called Mind the Gap, where they talk about the gap between what the actual return is, say, on an ETF and what the actual investor gets for their return of that ETF. And there's an interesting part here where they say low fees tend to lead to higher investor returns. Now, you may be thinking, well, duh, if you're paying less of a fee, then you're going to get more of a return. But we're not simply talking about that. Let's look at this chart here. They've gone ahead and broken this down into different types of categories. And we're going to look at the equity category here. Then they've gone ahead and taken the fees that they charge and broken it down into the lowest fees, which would be here at number 1, and the highest fees here at 5. So these quintile of fees. And then they've gone ahead and given what the average return is for an investor and what the total return is, in other words, what the ETF was making totally. And they give a gap here, so we see negative 1.1. But importantly, look at this. The investor return here, 6.56%. Then we go down to the funds that are charging the highest fees, and the investor return here, 3.59%. Now, if it was simply a difference between the fee that was causing this, then the gap here would be the same, but they're not. Negative 1.1 versus negative 2.2. And when we look here at total returns, we see that the total return here for the lowest cost funds, the lowest fees, 7.66% versus only 5.79%. So this tells us here that these funds that are charging really excessive fees, not only do they rip off their customers, but they also essentially are kind of ripping off themselves because they're making a lot less money than the funds that have the lower fees. Now this begs the question, just what is a reasonable fee to be paying? Well, according to this article in CNBC, Christine Benz over at Morningstar recommends that 0.5% is a good upper threshold for fees. Keep that in mind, upper threshold. That should be the maximum that you might be paying in fees. In my mind, 0.5% is still really expensive, especially when you compare that to the funds that you'll find over at Vanguard. Now, it's important to compare fund to fund. It's important to compare fund to fund. We're going to wrap up this discussion with a real-world example of this. I have here from Forbes.com an article that says the 8 best S&P 500 ETFs of December 2023. Now, if you're investing in an S&P 500 ETF that follows an index, the S&P 500, and in general, these ETFs are going to have the same holdings in the same numbers. Now, they might not be exactly the same, but they're going to be very, very similar. So we're going to compare the expense ratios of these very similar S&P 500 ETFs. When I scroll down here, the fund with the largest total assets is going to be this S&P 500 SPDR ETF Trust, and that goes by the ticker symbol SPY. It has $438 billion in assets, and its expense ratio is 0.945%. That sounds very reasonable if the upper threshold is 0.5%. But let's just look further into this. The iShares ETF, which goes by the ticker symbol IVV, the S&P 500 ETF, its expense ratio is only 0.03%, so about 1/3 the cost of SPY. Scrolling down a little further, we find that the Vanguard S&P 500 ETF goes by the ticker symbol VOO. It also only has an expense ratio of 0.03%. Would you rather pay 0.03% or 0.0945%? But wait a minute. Scrolling down just a little bit farther, we find that the SPDR folks also have another S&P 500 ETF. It goes by the ticker symbol SPLG, and its expense ratio is only 0.02%. Now, why in the world would SPDR be competing against itself with another ETF that has an expense ratio that's almost 1/5 the cost of SPY? Well, it has to do with competing with IVV and VOO, the iShares and Vanguard S&P 500 ETFs, which are that 0.03%. So SPDR is offering some competition here for the folks who are really, really looking for low costs. Now, there is one other nice feature about this SPLG ETF, and that has to do with its share price, and that is $54.27. If we look at today's price for the SPY ETF, you'll see that it's $461 and just change, 64 cents. So this SPLG offers folks who might not be able to pay $461 for a share to get into the S&P 500 at $54 per share. Now, notice that the total assets are only $23.4 billion, so this is not quite as liquid as the other SPDR ETF, the SPY, but I don't think that you're going to have much difficulty selling this particular ETF if you needed to sell to get the cash. Now, what's the take-home message for today's video? I think that there are three. The first take-home message is that fees can eat into your returns significantly, and I've showed you how over the course of 30 years, you're looking at potentially $200,000 difference when it comes to that particular scenario that I showed you. What's the second take-home message for today? Well, I think the second take-home message is that you need to get your fees down as low as you reasonably can. You're not going to be able to get it down to zero. Nobody's going to run your investments or let you participate in their brokerage firm for 0%. That would be called a volunteer, and volunteers aren't going to manage your money. However, getting it down to something that is reasonable, we talked about that threshold, 0.5%, certainly get it way down less than that 1.5% or 2% that the average investor is paying. And then number 3, we talked about being able to compare, not only comparing high cost to low cost, and I showed you how those low cost ETFs not only charge you less, but your overall returns are going to be greater according to that article at Morningstar. But also being able to compare fund to fund, all things being equal, looking for the fund that has the lowest fee may be in your best interest. It's something that you'll certainly want to look into. I hope this was helpful for you and informative. If it was, please give us a thumbs up, and we'd love to have you as a subscriber. Until next time, enjoy your investing.